Hey, how are you? It's Adam from Taylor Financial. We are upping our game today as we're going to show you a digital whiteboard that we use for a lot of in-person meetings here at the beautiful office in Tampa. So I was meeting with a couple business owners a few days ago, and I asked them, do you know the difference between a traditional IRA, 401k, and a Roth? And a lot of people do not know the difference. So I went through a digital and kind of visual representation of what the difference between those two are, and it seemed to help. So I thought I'd record a quick video just to go over the differences between Roth and traditional assets, whether again 401k or IRAs. So let's draw a bucket of money. Let's see how I do here. Not my best, but you get the idea. So a bucket of money, and let's talk about we're going to contribute whether traditional or Roth assets into this bucket. So let's start with a traditional. So with a traditional, as you contribute money to this account, you get a tax deduction, which is great. It grows tax deferred, but then when you go to take it out, guess what? Uncle Sam has not been paid, and he is going to tax you on the full amount, including the gains. So a Roth is a little different, and I'll get to that in a moment, but let's talk about these business owners. They're 30 years old, and they want to, let's say, retire at the age of 60. Maybe it's sooner, maybe it's later. But just from a growth standpoint, let's talk about the age of 30, age 40, age 50, 60, maybe even we look at pulling out money later at the age of 70 or 80. Okay, so we know the rule of 72 says if you get 7% on your money will double every 10 years. Sorry for my chicken scratch and the glare there, but the idea is that rule of 72, if you get 7%, which we believe is conservative long term, your money will double every 10 years. So let's say these business owners, they put $10,000 in at the age of 30. So 10 grand goes in a traditional format, they would get a tax deduction on that 10,000, but let's see what it grows to. So if we get 7% in our money, that 10,000 grows to 20,000. At age 50, that grows to 40,000. Age 60, 80,000. And even if we go out further, 160,000 or 320,000. So let's say at the end of the rainbow, 80,000, that was awful, but you get the idea. That's a K. Or 320,000. Somewhere in between those values, right? Now, granted, there's a lot of variables. What will taxes be? What if I get less? What if I get more from an investment growth standpoint? But let's just stick with some of the simple visual math. Money doubles every 10 years at 7%. So you put 10,000 in, it grows to potentially 80,000 to 320,000. And the question is, what would you rather pay taxes on? Would you rather pay taxes on this seed or on this potential large harvest? Most people are going to say, I'd rather pay taxes on the seed. And that's exactly what a Roth asset does. Whether it's a 401k, IRA, simples and steps now, the idea is that when you put money into a Roth, you don't really get that immediate tax deduction because you do pay taxes on that contribution. However, it grows tax-free, and then when you go to take it out, it's all tax-free, including the growth. So again, think about, would you rather pay taxes on the seed and the harvest? Depending on your income now, depending on your age, the answer may be different, but especially for a 30-year-old, this could be game-changing when it comes to reducing a lot of tax liability in their long-term future financial plan. Hope this helps. Horrible bucket of money, and I need to work on my font and my handwriting. See ya.